you very much. Thank you very much, Doug. Thank you, Indira, for that very kind introduction. Thanks to all of you for coming here. I hope you're all sitting comfortably, because you have come to an economics lecture. And it's a beautiful telecenter. 5 years ago, you're right, David Dodge gave this lecture, and I'll refer to what David said. We were in a different lecture theater. I can't remember exactly the one. It wasn't quite as nice, so that's possible. But there's two rewards for being here. One, you're sitting comfortably in the telecenter. And secondly, Indira has offered to take us all as a reward to the faculty club afterwards, which is something very special. I'd like to also thank Phyllis Clark for being here. Phyllis, known to many of you, a senior role here at the University of Alberta, but also known well to me and my colleagues at the Banque of Canada. She serves as Alberta's director on the Board of Governors of the Banque of Canada, and thank you for your presence here, but also for your public service to Canada in that role. And Indira, I will say, I should acknowledge your public service to Canada, this province, the country, and the world through your leadership in education. Okay, now the work begins. It is an honor to deliver the Hanson Lecture, and that is not an understatement, because in the history of the Banque of Canada, in the history of macroeconomics, monetary economics in Canada, this lecture holds a very special place. A quarter century ago, Governor John Crow, delivered this lecture in 1988. This later became known as the Edmonton Manifesto. And it did because in that talk, Crow outlined a clear commitment to price stability as the ultimate goal of monetary policy, and he set the stage for the introduction of inflation targeting and the subsequent dramatic fall in both the level and the volatility of inflation in Canada. Now, the preamble to the Banque of Canada Act is very long, and you can read just about anything into that preamble. And since it was written in 1934, we have read just about anything into that preamble. What Crow did was to focus his core insight was that the single objective of price stability would be the best way that the bank could fulfill its obligations to generally promote the economic and financial welfare of Canadians. 20 years later, Indira referenced this, David Dodge was on this stage, and his remarks followed the consequences of what John Crow said. 20 years of very successful inflation targeting here in Canada. We had an experience where inflation averaged exactly 2%, exactly what the target was, and real GDP growth in Canada had been 3%. And you see the sharp adjustment and the low volatility of inflation over that period. As well, the influence. Canada was the second country to adopt inflation targeting just after New Zealand. 27 other countries, by the time David stood up here, had formally adopted inflation targeting. Many more were informally doing so. And despite the fact that there were a few tremors in international financial markets, and David was once again proving that his timing was impeccable, there was reason to believe, at least with respect to how to run monetary policy, things were about as good as it gets. But David Dodge, for those of you who know him, Indira, you know him well, others of you know him well, he's not the type who's ever satisfied. His entire career has been focused on sort of a relentless effort to improve public policy. And so he asked whether we were actually at the end of monetary policy history. That was the core of what he said here a little more than 5 years ago. And he set out two major research topics. The first is, basically, is 2% low enough? Hello. How are you? Good, sorry, just recognizing the greatest Minister of Finance in my time here in Alberta. Yeah. Although I just came from seeing the equally great Minister of Finance, Doug Horner, I should say. Because this is public lecture, right? Yeah. So I have to say it. Okay, sorry, so David puts up two things. First, is 2% low enough? Can we do better? And that's really in the spirit of what John Crow was saying, because John Crow had put out price stability. We got down to 2%, and John would have arguably wanted to go further. So David says, can we go lower than that? And should we switch from targeting the rate of inflation to targeting the price level? One's a level concept, one's a growth concept. But basically, what he was saying, and implicitly what the bank started researching was, could you combine the two? So in effect, the bank would deliver true price stability or 0% inflation. Now, events intervened, and within a few months, the global financial crisis erupted in its full fury. And interest rates came down to, quickly were coming down to as low as they can go, something called the zero lower bound, which is basically as low as interest rates can go. It was less a theoretical curiosity than a real reality, and fundamental questions began to be asked about the role of central banks. And the debate really quickly shifted internationally, not so much here, but internationally, from whether inflation targeting could be refined, David's question, to whether it could be salvaged. More fundamentally, the crisis put in sharp relief the role of monetary policy in the pursuit of financial stability, and I'm going to talk more about that. It was a painful reminder that we never value something as much as when we lose it, and that I'm referring to financial stability. So even though we had the best and most resilient financial system in the world, we recognized the importance of these questions. We added that third one. Now, it has to be said, so those are the three questions we've been looking at over the last 5 years. The issues facing monetary policymakers around the world are broader still. Globally, central banks are now being simultaneously accused of being ineffective on the one hand and too powerful on the other. We don't know what to do with all the power we have, apparently. And the goals, the fundamental goals of monetary policy are being called into question. The shorthand would be, is price stability enough? So the very point of John Crow is called into question, again, beyond our shores, but I think we have to address it. So I'm going to address, the core of what I'm going to talk about is, what does the crisis and the post-crisis experience mean for monetary policy frameworks? What does it mean for how we operate, our tactics, and what does it mean for how we interact with fiscal policy, with regulators, with so-called macroprudential policies? I'm going to try to organize this around a bit of the crisis history, a bit of the lessons learned from the crisis, and then what it means for the frameworks. But I'll warn up front that the experience has still generated more questions than answers, and that's a trend I'm going to continue today. So let's talk briefly about monetary policy pre-crisis. And since I'm in a university setting, I'll stretch and say, I'll call to mind sort of Hegelian history and the idea of history as progress. Francis Fukuyama sort of famously picked this up, this idea that, history, we oscillate between synthesis and thesis, antithesis, synthesis, thank you, towards ultimately a rational form of society. Fukuyama was, liberal, market-oriented democracies as being the perfection of society. So that's when David was saying, are we at the end of monetary policy history? That was David's sense. Have we reached the end of, the apex of frameworks? And that optimism appeared well-founded. The adoption of inflation targeting, as I say, I've got a Tailor Frontier up there. That must be very confusing looking at that while I'm talking about this. Sorry about that. A long period of tranquility. Now I'll go to the Tailor Frontier. This is basically the decisions, and this is relevant, what central banks think about. On the x-axis is the variance of output, GDP. How much does it go up and down? You can also think about the variance of employment. You could use employment on that x-axis. And then on the y-axis is the variance of inflation. And we try to set policy in a way that minimizes those variances. Now, some central banks care a lot more about minimizing the variance of inflation. Some are somewhere in the middle, and some very much focus on output. And so they pick an optimal point on that curve. And that curve is obviously pulled back through time. It's a time series. Prior to inflation targeting, there was a much higher trade-off than once people brought in a clear monetary policy framework. What's important to recognize is that So the question is, was this the best framework? Was it the end of history? History doesn't mean, the end of history doesn't mean the end to shocks. There's still shocks to the system. But it does mean that a focus on price stability, or was thought to mean that a focus on price stability was the best contribution. So the fundamental question I'm asking today is whether recent events merit, at a minimum, they merit a reevaluation of that conclusion. And in order to do that reevaluation, we need to look at the foundations and the practical application of inflation targeting. Now, the theoretical underpinning of inflation targeting is something called the New Keynesian Synthesis. If you want to read the much longer version of my speech, it's explained in that. There is a much longer version of this speech, by the way. At the core of this is a central role for expectations, how expectations are formed. The fact that wages and prices, some wages and prices are sticky, so they take a while to adjust. But fundamentally as well, that there is not a long-run trade-off between inflation and output. The practical application of this was what John was leading up to. John Crow was an inflation targeting framework with these following main elements. First, obviously a clear objective, 2% CPI inflation as the target. Secondly, an independent central bank. A central bank which is given a mandate by the democratically elected parliament, executive, but then is given operational flexibility to decide how to achieve that mandate. And the reason for that is we learned over time that there's a time inconsistency problem. There's a temptation, there's always a short-term temptation to have a bit more inflation because wages are sticky, so that real wages fall, so that employment increases, so that you get reelected. And you need to pull out that temptation. And over time, agents learn that is what will happen, and you end up with a equilibrium with a higher average level of inflation because the hands of the central bank in the parlance aren't tied. So, independent central bank, one instrument, basically the short-term interest rate, and very importantly, to help with those expectations that are at the heart of it, transparent communications. So, but one aspect of this framework, you don't see anything really about the financial sector there, and there's a very narrow view about the role of monetary policy to address financial vulnerabilities. The extent to which prior to the crisis, and obviously this is a bit of a caricature, but it's largely true, prior to the crisis that central banks thought about financial variables, asset prices, it was really only to the extent that they had implications for inflation and inflation over a medium-term horizon. There was also a general consensus that it was better for central banks to clean up after a crash than to lean or try to prevent a crash. That was based on a few premises. First, that it's actually hard to tell if there's a bubble. It's difficult to make those valuation determinations. Secondly, monetary policy is a very costly way of pricking the bubble. You cause a lot of collateral damage. And thirdly, that it's not too costly to clean up after the fact. You can guess which one of those is clearly not true. Implicitly as well, though, there was an assumption that markets are generally efficient, that they stay open in virtually all states of the world, and that they continue to clear. And all of this has implications. This consensus has implications for how central banks are organized. Almost all central banks did have a financial stability objective, but the financial stability wings of the central banks operated. It was very much two solitudes. There was a monetary wing and there was a financial stability wing, and they didn't talk to each other. There wasn't cross-fertilization of the individuals. The models didn't talk to each other either. The models we had ourselves actually generally didn't have financial systems in there, and actually, the extent we did, couldn't produce anything near the kind of dynamics that we saw in the run-up to the crisis. And with the crisis. Consequence of all this is that it's fair to say that most policymakers didn't see the crisis coming, didn't understand the extent to which there was huge amounts of what we would call endogenous credit or endogenous liquidity being created in the system, liquidity that would then collapse on itself. And even to the extent to which we worried about large current account imbalances, we didn't make the connection between those and the financial system and some of the risks. And so when the crisis broke out in 2007, and even when we were here in early 2008, it was viewed more as an exogenous event. It was caused more by problems with incentive structures in financial institutions, greed. It was caused by lack of transparency in certain markets, such as securitization. So focus on micro factors as opposed to the macro factors. And even the terminology at the time, and this wasn't just central bankers being coy, the term used at that last lecture would have been turbulence. It was turbulence. A little chop as you're flying across the prairies. We had a little chop today, didn't we? Nothing too serious. We had to fasten our seatbelts, but it was okay. We still got breakfast. And I remember Jean-Claude Trichet, a colleague, a fantastic central banker, but he spoke for many. It was at Jackson Hole in the summer of 2008. After which, this is at a point when Bear Stearns had failed, when the GSEs had just been rescued, so Fannie and Freddie, when other institutions were on the brink, and he said it was only after that that he was prepared to begin to speak of a crisis. That's a quote. A couple weeks later, the turbulence was a little too severe to ignore. President Bush faithfully kept with the analogy of turbulence and told his cabinet in an emergency meeting, this sucker could go down. Sucker could go down. So that was the signal to act. And we did act. The financial stability wings of central banks sprang into action. All these conversations that hadn't been happening started to happen. We put in place Bagehot's dictum, which is to lend liberally in a crisis at a penalty rate. This is the Bank of Canada balance. These are extraordinary liquidity facilities. The Bank of Canada, you see, spring up with Lehman to provide liquidity. This is in the strongest financial system in the world. That is an increase, almost doubling of our balance sheet in the space of weeks to keep the system going. Again, it's liquidity against collateral, but it's necessary because financial stability is at the center. Trillions in the end, not from us, but collectively are provided in extraordinary liquidity facilities, different types, repos, discount facilities, reciprocal swap arrangements, and they provide. Initially, it's to keep the financial system going, but the realization is that actually it's, and this is a very obvious point, but through the financial system to the real economy, and the links between financial stability and price stability become much more evident. Obviously, there is a huge monetary response as well. Interest rates are cut to as low as they can go, big expansions of balance sheets. And at the end of this, not that we're at the end, I wish we were at the end, we're close to the end, let's say. More than the end of the beginning. You have the two major non-inflation targeting central banks, the Federal Reserve and the Bank of Japan, within the past year, declare themselves as inflation targeters. So there's something in there, despite the failures that we're seeing. So, and I think the way we get to where we should go and how we should think about inflation targeting is first look at these 5 core lessons that we picked up from this experience. So first one, John Crow, I think, would be happy to hear, reconfirmation that price stability remains paramount. And the issue is, well, what else? How else do we address the fact that price stability can be associated and often it can actually cause the very financial instability we're trying to prevent? So, and in that regard, let me say one other thing, which is that looking back, a lot of the dynamics in financial markets were encouraged by a complacency comes into financial markets and financial market actors because things are stable. And the assumption becomes that past stability will persist and people start to basically become complacent and borrow against that. But it's also the fact that there is an explicit clean doctrine out there for central banks. And you can think about how that would reinforce risk-taking behavior. You have a central bank that won't say if there's a bubble, if things have gotten out of hand. You know that it won't respond. The central bank's not going to respond. It's not going to tighten policy just because there's pressures there. That's explicit, because that's clearly the wrong thing to do. And if something bad happens, don't worry, we're going to mop up. All of those are sort of licenses to continue to take risk. So there, and the other thing that we don't, I think we appreciate better now, is recognizing that I spoke earlier about the importance of expectations. Well, expectations can work two ways. Expectations can be stabilizing or they can be destabilizing. And in financial markets, anyone who's lived through them for any period of time knows that they're prone to bouts of euphoria and despair. You think of the work of Hyman Minsky, somebody who was rediscovered after the crisis. I saw in the economics department today a poster up for a seminar on him, so it's certainly alive and well in the University of Alberta. Basically, Minsky captures the cycles in finance, where you have stability encouraging ultimately exuberance, excess, and a subsequent reckoning. As well, and you know this from behavioral economics and from life, that people make mistakes about estimating their future incomes. Now, reasons can vary. There's a new technology. People can get excited about it, extrapolate unreasonably how far that's going to go. Again, prolonged stability can get people to assume that the future simply looks like the recent path. What matters is that that process creates a self-reinforcing asset and credit boom. And if that dynamic persists for years, you can leave households, businesses, and banks very badly exposed when reality reasserts and the future becomes now, and the recognition that incomes aren't growing to the sky is there. So, what's the role of monetary policy? You saw this for a nanosecond before. It's the last line of defense. It's not the first line of defense against this dynamic. The first lines, we start with the behavior of individuals, responsibilities of individuals and institutions. Then we go to microprudential supervision, so what the bank regulator, for example, would do. And then we look to macroprudential tools and supervision. And these go a long way, and we've shown in Canada they can go a long way to reduce those excesses. But there may still be cases, and this is a question, it is the last line of defense. It's not absent from the playing field, if you will, to mix the metaphor, where monetary policy has to take financial stability considerations into account. It's easy if financial stability issues, financial cycles affect the near-term outlook. That's easy. That was easy in the crisis. Crash, ease monetary policy, get back to towards target. But in general, we now argue that monetary policy should be at least complementary to macroprudential efforts. So if the Government of Canada is tightening mortgage insurance rules, monetary policy shouldn't necessarily work at cross purposes in the stabilization of household borrowing. The question whether it actively leans, is more activist than that, is a function of how serious the issues are. But there are exceptional circumstances, in our view, when financial imbalances can pose an economy-wide threat, or when the imbalances themselves are caused by the stance of monetary policy, that monetary policy itself may need to support financial stability. The fact is, monetary policy has a broad influence on financial markets and on leverage of financial institutions that can't be easily avoided. Yeah, I'll leave it there, actually, just to save you the rest of that argument, but I think it's clear. I can always come back in the Q&A. The third of my 5 lessons, central banks aren't powerless at the zero lower bound. At the onset of the crisis, and part of the motivation of David Dodge putting up price level targeting was fear of being at the zero lower bound. It wasn't clear that we would have the tools to operate. This was more of a, with the exception of Japan, it was basically a theoretical curiosity, became a reality very quickly. We've learned that actually there's quite a bit that central banks can do at the zero lower bound, but you don't want to go there. It's not that much fun. The effectiveness of unconventional, this is the reason they call it unconventional policy, the effectiveness of unconventional policy is more uncertain, the risks are more varied, and the exit from these policies is as yet untested. This slide just gives you a sense of the orders of magnitude of increases in balance sheets of those central banks that have engaged in some form of quantitative easing. And to give you a reference, the first number on the y-axis is 5%, 5% of GDP. That's the size, the absolute size of the Bank of Canada balance sheet. And these are all increments since 2008. The shaded bit is what's to come with announced programs. So for the Bank of Japan, there's a very clear policy of doubling their balance sheet. But you have balance sheets of effectively the major central banks, which are 5 to ultimately about 8 times relative to their size of GDP as large as the Bank of Canada. Now, by and large, we think these measures are a good thing. We think that in their absence, the results might have been a much deeper recession, higher unemployment, and even weaker inflation. But there is a related issue, which I'm not going to go deeply into, but these unconventional measures raise broader issues about the role of a central bank, issues around the coordination with fiscal policy, for example, issues around independence, and it puts a premium on well-articulated frameworks, monetary policy frameworks, agreed in advance with, between the central bank and the fiscal or executive authority. My fourth point, communications matter. Again, expectations are important. We've learned that. Communications, very important for the formation of expectations. When we got to interest rates to as low as we could put them because of the crisis, and we judged that we needed additional stimulus, what the Bank of Canada did is we gave what we call forward guidance, a sense of where interest rates were going to go for the next 15 months. And they weren't going to go anywhere for the next 15 months. That's basically what we told Canadians, conditional on the outlook for inflation, but as clearly as we could. And I think it was a message that was understood and was helpful to the recovery. That was the sort of second generation of guidance. It effectively gave a time horizon for it. And the reason it worked, we think, was because it was exceptional. It wasn't something we normally did. It was explicit. It was as blunt as I just said. And it was anchored in a highly credible inflation targeting framework, so people weren't worried that inflation was going to bounce up. It also worked on the margin because we put our money where our mouths were. I showed you that chart earlier of the balance sheet going up by billions of dollars. We said we're going to keep that out there until rates go up because it was stimulus at the same time, so it was consistent with it. And it also worked because, as I say, it was a simple statement. It went over the heads of the kind of central bank watchers in the financial sector, not that they're unimportant, but went over the heads and spoke directly to Canadians. Importantly, this past December, the Federal Reserve took this to the next level, the third generation of guidance, and they announced a precise threshold based on unemployment that must be met before their interest rate would be raised. Now, it's not a trigger, so it's not automatic, but it's a threshold that must be met, 6.5% unemployment, before they even think about raising interest rates. And while they do this, they include a knockout. They say, this is the case. We're not going to raise interest rates until unemployment gets down to 6.5%, unless we think inflation is going to be 2.5% or above 1 year forward. And this is so-called state contingent guidance. All of these types of guidance, and most effectively with the Fed, do a couple of things. One, they extend the timeline that rates are low. That's worth something. But they also, importantly, increase the certainty with which rates are low. So just kind of given a hint, you get a minimal advantage for that. Given a time period, you get if you're credible, you get something for that. Actually making it contingent on an economic outcome that you don't directly control further enhances the credibility of that commitment, the certainty around it, which provides additional stimulus. The other thing it does, and this is important but techie part of my speech, the other thing it does is that it reveals information about the central bank's discretion. So what the Fed has done is it has drawn into sharper relief the type of trade-offs, remember that Minsky frontier between output and inflation, the type of trade-offs a central bank has to make between output or employment, use those examples, and inflation. So what are we willing to tolerate? What do we need to see in order to adjust? And the way economists talk about this is it effectively reveals the reaction function of the central bank, how the central bank is going to react to various events. In the extreme, and I'm going to talk about this in a bit more detail in a second, it reveals the absolute extent of the flexibility that a central bank has under its mandate or its remit from the political authority. So we have constrained discretion to achieve that inflation target. We can take a different amount of time, as one example, in order to achieve it. And using tools like this, it's revealed how we do it. And in doing so, and in being transparent about it, importantly, we increase the likelihood we retain our credibility that we're going to meet our inflation target, and we continue to anchor inflation expectations at that target. The last lesson, that's showing the conditional commitment. I should have shown that. That's just the move down in interest rate expectations from the red to the nicer color after we did it. The last one is the need to complete the contract. And this is just picking up on this, what I was just saying, which is that the central bank effectively has the ability to determine the optimal path, what it thinks the optimal path, within limits, it can determine the optimal path to go back to target. But those boundaries were seldom explicitly defined. Now, when inflation targeting was set up, not entirely by accident, it coincided with a period known as the Great Moderation. Normal monetary policy always works with lags. Normal lag is about 6 quarters. That's the normal horizon central banks would take to get back, 6, 7, 8 quarters, something like that. The ambiguity, the fact that the political authority, the executive authority, hadn't defined the limits, that didn't matter. And this dynamic creates a virtuous cycle where expectations are well anchored, and that very fact makes it more likely we get back on time. But in the world of the crisis and the post-crisis, when the shocks are huge, it's not clear that those are the right horizons to get to the right point on the horizon. And that ambiguity, that uncertainty about what the limits are of the flexibility can be quite unhelpful. And so this all raises fundamental questions about the appropriate constraints on the central bank's delegated authority. I'll just be absolutely clear. This is not an appeal for looser policy. It's not a general appeal. In some circumstances, policy could be looser. In other circumstances, it could be tighter. You think of the case I started with, the issues around financial stability, where policy on average, to prevent future destabilizing financial vulnerabilities, policy would be tighter than otherwise. And inflation would come back farther over time. The key issue is that you need a clear framework in order to make this work. It enhances accountability, and it makes expectations work in your direction. Give an example here from Canada. We have adopted, the Banque du Canada in the spring, about a year ago, spring of last year, adopted a tightening bias on interest rates, a function of the outlook for output and inflation in Canada, anchored in the inflation target, but also reflecting the evolution of risks on household debt and the housing market in Canada, saying that might be a factor, not the core factor, but might be a factor that affected the timing and degree of any withdrawal of monetary stimulus. The government, in a prudent and effective and timely way, tightens mortgage insurance rules. OSFI, in an intelligent and effective and appropriate way, tightens some of their rules, underwriting guidelines at the same time. There's an increased appreciation of Canadians about the risks associated with elevated debt. All of these together contribute to a more constructive evolution of the housing market, household debt. The rate of household debt accumulation comes down from more than 6% to about 3% growth, and the amount of floating rate debt the amount of fixed rate debt goes from about a third of mortgages to more than 90% of mortgages today over the course of the past year. So there's a bias, there's leaning, and it supports a better outcome. Now, for completeness, I'm going to talk about 3 cases where there may be a desire to use greater flexibility. I just referred to one, a Canadian case. The first is that you could have a shock that's very large, very persistent, and you might want to have a longer horizon to bring inflation back to target. The example here, the blue is just a standard shock, the blue line. Inflation comes down, you have a negative shock, you provide monetary stimulus, you can calibrate it. This is David Dodge days. This is a good. Life was good then, right? The green line, you have a big shock. You have a bigger shock which knocks inflation down, and the judgment has to be: do you provide massive stimulus? And you can provide. These are model simulations, so you can provide massive stimulus, but it's very hard to not just rocket right through the 2% target and overshoot, and that brings greater volatility ultimately. But you get back roughly in the same 6 to 8 quarter timeline that you used to do. So everyone's happy for that moment, and then you go to the Bank of England and someone else has to clean it up. But then the red line is the better, you're taking longer to get back, calibrating stimulus appropriately on the horizon. The second example is what I talked about in terms of allowing to promote adjustment is basically the leaning example I gave at the heart of this, which is that you can inflation target and ignore the red line, have the great crash we just experienced, huge deflationary pressures, long road back. It's a little unfair, but that's kind of the U.S. path right now. Or you can lean in the blue. Inflation is going to be lower than target for some period of time, but it's going to gradually come back. What's not shown, and I'll show later, is that the output consequences of all that, the volatility of output and the overall output and employment consequences over that period of time are superior. The last one is even more complicated than the other ones, I'm afraid. But this has to do with asymmetric risks. And effectively, quite often risks when we look at the outlook, it's always risks on the upside, on the downside. Things could be better in the US, they could be worse in Europe. But let's take the example of things being worse in Europe. Things could be really worse in Europe. And so the question is, how do you manage policy when you have that bigger risk there? Normally what we would do is we have a mean scenario. So we just say, okay, here's the relative probabilities of the various risks happening. And we set policy on an expected value basis. And in this case, because there's a risk, and it's represented in the blue, a risk of a very bad outcome in a very large economy, we actually end up running policy slightly loose. And on average, mean expected value, inflation is going to be a little high, but we're taking out some insurance because things could be really rough. But by the way, if the risk materializes, the existential crisis in Europe materializes, policy's been too tight and there's going to be a sharp drop in inflation as per the blue. But in the most likely scenario, the modal scenario, where things kind of move along, policy is actually even more loose than it would have otherwise been. So the inflation overshoot is higher. And the judgment has to be made by a central bank, again, about what's the right path, given the implications of all those for the integral, if you will, of output and inflation. So I'm going to go to what we have learned. Did I go to what we have learned? Yeah. Yeah. Not quite sure that's right. Anyways, I'm going to keep on with my text. The first thing we learned, price stability, paramount goal of monetary policy, for all the reasons that John Crow outlined and has remained in our understanding. There's not a long-run trade-off between inflation and unemployment. But the second thing is also true, that we need to incorporate that price stability itself doesn't guarantee financial stability. In fact, it goes further than that. It can actually cause financial instability. And the issue with that is that you end up, and I promised you, because I know you enjoyed it so much, bringing back the old Tailor Frontier, which in the black curve, convex curve closer to the axis, that's the Tailor Frontier I showed you earlier. And so the central bank in the old world targets A. That's its optimal path of variance in output and inflation. There's a shock, we got to get it back. We figure out the path, it comes back on those lines. The problem is that not recognizing that the degree of price stability can cause financial instability, and that the financial instability itself causes a big variance in output, and ultimately one of those big curves down and curves up that I showed you earlier, that targeting A ends you up on B. It's not the Tailor Frontier, it's the Taylor-Minsky Frontier. That's a term of Mervyn King, current governor of the Bank of England. And what the central bank actually wants to do, given its preferences, society's preferences, is target C. So it's got a little more variance in inflation, less variance in output than in terms of what it's actually realized. And that's because monetary policy on the margin plays a role in supporting these other objectives. And it's not and I think the important point to recognize is that B there is an arbitrary outcome. You thought you were getting A, you end up with B because you don't understand you don't fully understand how the world works. So why does it, so what? If you're probably wondering, which is fair enough. The reason for this is that the scale of the shocks that we are facing, current shocks and leading stretch conventional flexibility, again, the scale of the shocks that are facing the global economy right now make this part of the relevant decision-making of a number of central banks. And this complicates the conduct of monetary policy, doesn't absolve the central bank of its responsibilities under the Preamble to the Act. It's important to have a clear framework, though, in order to meet those responsibilities for a variety of reasons, democratic accountability at the heart, but also because if you have a clear framework, people can understand what you're doing, and that makes the probability of success higher. The use of communications, so agents must understand central banks' reaction functions, be quite a, just that phrase means that people can't understand what you're talking about, but that's the economics of it. You need clear frameworks, and you need transparent communications in order to bring those frameworks to life. And things like what the Fed has done, state contingent guidance, saying we're not going to adjust policy till certain unemployment, et cetera, is achieved. That helps to crystallize the boundaries on what the central bank can do, and it provides that clarity and flexible inflation targeting. Now, as in everything, there are limits. You can't do this too frequently. You can't stretch it too far, but you cannot do it by stealth. You try and do it by stealth. You try to pretend that you're on the old regime. It's the same time inconsistent. It's a different variant of that time inconsistency problem I talked about before. And any changes, again, back to the accountability, to previously understood horizons should be sanctioned by the relevant executive or legislative authority, which ultimately defines the constraints on a central bank's discretion. I'll just, before I conclude, just one final point of context, important point of context. Obviously, we shouldn't look at all of this in a vacuum. Central banks aren't looking to do it all. They shouldn't be expected to do it all. Different authorities have different absolute and comparative advantages in addressing problems. Central banks should play an important role in assessing problems to come, vulnerabilities. The microprudential authorities, the bank regulators, for example, should first line of defense. The macroprudential authorities, federal government, CMHC, people like that, second line of defense. They're the first responders to these risks. It's absolutely important that there's cooperation and coordination, as there is in Canada. Over time, there's going to be more progress in macroprudential tools and in microprudential supervision. And very importantly, I would like to think, and you kindly referenced the FSB, I would like to think that the G20's work, the FSB's work there, is going to reduce the occurrence of these systemic events. And if our ambitions in this sphere are realized, monetary policy will be better able or more likely to be able to focus on its main mission. So the conclusion, I won't go through all of this in detail, but basically the way I wanted to conclude was to say that it has been a fascinating, somewhat harrowing 5 years since David gave his lecture. As I said, we have many lessons. We've got a lot to learn. That is a list of some of the most important research, in our view, and they're detailed in the written version of the speech, research topics that we're working on at the Bank of Canada, and with some of you here can contribute directly, and many of you more, we hope many more will over time. The last one is continued work on frameworks. That's monetary policy frameworks, what John Crow talked about, what David Dodge set up, what I've talked about. We want to continue to look at improvements to the monetary policy framework. We view that as our responsibility. Our board views that as our responsibility to look at alternatives. Some of these might help exiting or avoiding the zero lower bound. Some of them might achieve better trade-offs over time. I would say one of the core strengths of the Canadian system is that there's a periodic review of our monetary policy framework. Every 5 years, the agreement between the bank and the government of Canada is renewed. And that provides an opportunity to bring in learnings as we have over the course of its existence. So I finish by just noting I'm leaving you with more questions than answers. I expect a future Bank of Canada governor will deliver the future Hanson lecture that ties it all together. Et il faut le dire, peut-être qu'elle m'écoute actuellement. Thank you very much.
Well, thank you, Governor Carney. Governor Carney has agreed to have some questions from the audience. We only have about 15 minutes for questions, so what I would do is ask you to come to the microphone. This is being webcast, and when the microphone is live, then state your name and your question and try to be as succinct as possible.
Great, thank you. Hi.
Governor Carney, thank you very much for that very good speech. I believe, and correct me if I misunderstood you, you said something to the effect that central bankers didn't understand the risk involved in the last crisis. Now, a number of years ago, we had a vice president of J.P. Morgan that basically said the same thing, that the senior management in J.P. Morgan didn't understand the extent of the risk that they were taking on with the mortgage-backed securities. But anybody could realize that if you're lending 110% of the value of real estate to people that don't have any income, you're going to have a crisis. Now, I see a similar thing happening in the United States, Europe as well, with Bernanke printing money, $85 billion a month, I believe it is. Can we not see what's going to happen with this? I'm a layman, so it's pretty hard for me to comprehend what's going to happen, but it looks like a crisis in the making.
Well, so the question relates to, I'll phrase the question slightly, which is, the question relates to quantitative easing strategies and specifically the United States. I'm going to answer in the general because it's not my role to speak for the Federal Reserve or any other central bank. The quantitative easing, these strategies, they're clearly unconventional policy, and they are policies that substitute, when you run out of conventional room, changing the interest rate, you can't make interest rates go negative effectively. When you run out of conventional room, and there is a view that there's additional stimulus required, you have two options. One is to provide a greater certainty about the time horizon that rates are going to be low, guidance. I talked about that. We did it, and the Fed has done it in quite an inventive way. And the second way is to try to influence general financial conditions and general level of interest rates farther out the yield curve, but also general financial conditions, price of other financial assets, more broadly to encourage spending, in effect. And so the Fed has done that through this, and you're right, it is $85 billion a month is the current run rate of their additions to through quantitative easing purchases of assets. The benefits there are that the price of risk assets are much higher. It's cheaper for financial institutions, but very importantly, businesses to borrow. It has an impact on other assets. There's a wealth effect. It has an impact, I'm speaking in general terms, it has an impact on the currency, as all monetary policy has, which provides support for exporters. And their challenge is they have to calibrate that in a way that's consistent with achieving a 2% rate of inflation. The situation in the United States, and I'm giving a general answer, the situation in the United States is inflation is a little more than 1% right now. Those are all the benefits, and that's what they're trying to achieve. There are costs to the policy. The costs include distributional costs, savers to debtors. There are costs potentially in terms of the risks, and I talked about some of those risks prior to the crisis, and you'd say, why wouldn't we see them come? There's definitely risks in terms of having low interest rates and the impact of that on financial markets and participants and people taking too much risk. But so they have to make a judgment, anybody who's pursuing these strategies, of what's my marginal benefit of doing this in terms of more activity in the economy versus the costs of running these risks. At present, and I'll finish with this, the level of money in the broadest sense in the U.S. economy is still lower than it was 5 years out than it was prior to the crisis. And the reason for that is that the private money creation collapsed. And so the risk that people often cite is that there's going to be inflation, very strong inflation because of this. For this truly to happen in a way prior to the ability of the Fed to, or any central bank to pull this back in, you have to get quite a rapid expansion in private money creation. That happens through banks. This happens through banks that are supervised. It happens, you can see it coming, I think is the point. You can see it coming. Now, it's the responsibility of the central bank to pay attention and watch and make sure that it's coming and adjust the pace of that policy in a way that's consistent with that. So the question is entirely valid, but that's the risk-reward trade-off that has to be made. So,
we'll go to David over there.
Yeah, I have a question about institutions we might have in our economy similar to central banks. Money is essentially a publicly created commodity, and we've evolved over the last 100 years a very successful set of institutions, including central banks, to influence how it behaves in the economy, given that it is publicly created. In the face of environmental externalities, in particular those involved with climate change and for example, carbon dioxide emission rights, we have the potential for other publicly created commodities whose price we have to come to terms with, whether implicitly or explicitly. And I was wondering if there's a role for the creation of, eventually, if we actually are wise enough to create a price for these sorts of externalities, in particular carbon, for an institution like Banque du Canada that would have the mandate to determine those price levels.
Yeah, it's a very interesting question. There's not a perfect analog. This is not my core area of expertise, obviously. In the UK, about a decade ago, they had sorry, I've lost you, David, wherever you went. But okay, they had a central bank-like structure, not a central bank, but they had a structure, they had a board which effectively issued permits and judged the issuance of carbon permits which in and of itself would, in theory, would help determine, the carbon price or some, they're trying to figure out supply demand on the permits, and they had a board. It was actually headed by Adair Turner, who is, who's an outgoing head of the British regulator. They no longer have this board, so it didn't fully work. I don't know that you need, so there are some analogs there that have been, there's at least one that has been tried. The whole question of how to get the right price on carbon is a fairly large, throbbing third rail that I would like to not put my hand on at the moment. But I think one of the things we should recognize, though, with central bank, part of the core function which was tested, and I'll stop with this, in the crisis when I showed you that huge balance sheet expansion of the Banque du Canada, part of the reason we do that is not to set the price of all money, but we need to have the price of very short-term money set and anchored. And when the market collapses, as it did, that price of money was going through the roof in the absence of massive intervention, and we needed to anchor that there. Sorry.
Valentina?
Hi. So my question is just about the excess reserves of the U.S. banks with the Federal Reserve System. So as far as I know, they have increased dramatically during the crisis. Now I think they received 25 basis points as interest. Mm-hmm. And my impression was that this interest is paid to keep them there. But what is this? The question I have: do you think this is the new normal? That is, the excess reserve will be enormous for the foreseeable future?
Well, I think for foreseeable future there will, again, not speaking for the Fed, but in general, if there's been a dramatic expansion of the balance sheet and there are excess reserves back in effect at the ECB, for example, as well. And it goes back to the question, which was ultimately, I think you could interpret the first question as one about ultimately exit. One of the tools that the Fed and other central banks would have is that there's an ability to raise interest rates before you shrink down those massive balance sheets. And the reason you have that ability is as you raise interest rates, you raise the interest rate on excess reserves, and therefore you continue to keep that liquidity. You keep it back in the system, back with the central bank, effectively. And so that suggests that even with a exit, that excess reserves, there are substantial excess reserves for some time because it's part of the excess process. Yeah.
Thank you.
Any other questions? Okay, well, it's my pleasure to thank the Governor for his presentation. But before I do, I'd like to take a couple of minutes to highlight some of the activity of the Institute for Public Economics. Formed in 1996 under the directorship of Paul Booth, a key event each year is the Eric J. Hanson Memorial Lecture. In addition, each year the Institute hosts a postmortem on the provincial budget, which draws considerable interest. In March of this year, the Institute commenced the policy series. As an example, next month we'll be releasing a major study on labor shortages in Alberta. On May the 13th, our annual conference takes place. This year's conference is entitled Alberta Future Challenges and examines the tension between the objectives of economic development through energy investments and the goal of developing resources sustainably. If you have not registered for the course, I encourage you to do so. We are especially proud of being able to host this lecture and very grateful for the Governor's availability. As a public institution, we're pleased to provide a forum at no cost to the audience where important ideas are debated. The research and outreach of the Institute for Public Economics is essential to increasing knowledge of the public sector and the influence it has on the economy and society. A strong Alberta and Canada depend on sound public and monetary policy, and the IPE is committed to informing the public on these issues. Our recent provincial budget is a very good example of how public policy has a direct impact on us all. In order to deliver events like this lecture today, however, the IPE relies heavily on private donations, conference attendance, and corporate sponsorships. Now I think you know where I'm going here. As such, I would ask each of you to consider supporting the work of the IPE by making a donation to our institute. This can be done making a gift if you go online to www.ipe.ualberta.ca and click the Make a Gift box. I would also like to extend an invitation to anyone who is interested in the work of the Institute to come up to me at the reception and talk to me, or send me an email at raska@ualberta.ca. The Institute is honored that Mr. Carney has come to the University of Alberta to deliver one of his last official speeches before heading to London. As we know, the governor is a very busy person, and especially so as he transitions to the governorship of the Bank of England, and that doesn't even count your role as chair of the Financial Stability Board. This lecture sold out in 24 hours, testament to the public profile of the lecture and to the high interest of monetary policy issues. This should not be a major surprise, because in 1935, Albertans elected the world's first social credit government. This afternoon's lecture illustrates Dr. Carney's master of the subject of monetary policy and a good sense of humor. His penetrating insights in monetary policy after the fall is especially relevant as Western economies continue to struggle with anemic growth and high levels of public debt. Governor Carney, here is a small token of our appreciation for delivering the lecture. It is a book on the history of the University of Alberta. We all wish you the very best in your new job at the Bank of England.
Thank you very much. Thank you very much. That's great. Thank you. Thanks very much. Thanks, Indira.
What a great pleasure.
There is a reception afterwards in the atrium outside this room. We are very grateful to the generosity of the Canadian Western Bank in sponsoring this reception. I would also like to thank my assistant, Karen Buchholz, for the dedication and efficacy of managing all the details surrounding today's lecture and reception. A press conference with the governor is to follow in this room, so we would appreciate it if you could clear the room in a timely manner. Thank you again for making this the most successful Hanson lecture.